What if I told you that in 2026, the biggest threat to your gold and silver stack isn't inflation, it isn't the Federal Reserve, and it isn't even the next recession? It's you. Right now, across America, from Texas to Florida to California, everyday investors are rushing into gold and silver thinking they're protecting their wealth, but most of them are making the same 7 mistakes that quietly destroy returns, increase risk, and turn what should be financial insurance into financial regret. If you're stacking metals or even thinking about buying your first ounce, this could save you thousands of dollars. Before we go deeper, if you care about protecting your money in this unpredictable financial cycle, make sure you're subscribed to Metal Media Insight, because every week we break down what's really happening in the gold and silver markets in simple, clear terms built for everyday Americans. If you get value from this, hit subscribe now so you don't miss what's coming next. Let's start with the first mistake, and this is the silent killer in 2026. Buying based on panic headlines instead of price discipline. We've all seen it happen. A geopolitical flare-up, a shocking inflation report, or a surprise statement from the Federal Reserve sends gold up $30 or $40 in a day, and silver jumping even faster. Social media explodes with "this is it" posts, and new buyers rush in at the top of the move, not because they plan to buy at that level, but because fear of missing out took control. Then, 2 weeks later, the price cools off, and now they're sitting on a position that feels painful. In today's market, algorithms trade headlines in milliseconds. Retail investors who chase emotional spikes often end up buying after the smart money already positioned. Disciplined buyers set price ranges and buy in phases. Mistake number 2 is overpaying huge premiums without understanding the difference between spot price and what you're actually paying. In periods of strong demand, especially when physical supply tightens, premiums on popular coins can surge far beyond normal levels. Many first-time buyers don't even realize they're paying $5 to $10 over spot per ounce on silver. That premium becomes a hurdle you must overcome before you even break even. In 2026, smart buyers compare products, look at generic rounds versus government-minted coins, and decide whether that extra cost truly makes sense. Mistake number 3 is ignoring liquidity. Gold and silver feel liquid because they're physical and widely recognized, but liquidity depends on what you buy. If you load up on obscure collectibles with high markups, you may find that when you try to sell, dealers only offer melt value. Widely recognized products typically have tighter buy-sell spreads in the US market. Liquidity isn't just about owning metal, it's about being able to convert it back into cash efficiently when you need it most. Mistake number 4 is going all in at once. In 2026, volatility is normal. Between shifting interest rate expectations, rising federal debt, election uncertainty, and global tensions, gold and silver can swing sharply in short periods. Yet many new buyers deploy their entire budget in one purchase because they believe prices will never dip again. When a correction hits, regret sets in. Dollar cost averaging reduces emotional stress and builds confidence over time. The goal isn't to perfectly time the bottom, it's to build a position steadily and strategically. Mistake number 5 is confusing investing with speculation. Gold historically acts as a hedge against monetary instability and currency debasement. Silver carries both monetary and industrial demand, but neither asset guarantees short-term profits. In 2026, viral price targets spread quickly online. Some claim silver will triple overnight. Others insist gold is about to double within months. Those narratives attract attention, but real wealth preservation is built on patience. If your timeline is measured in weeks, you're speculating. If it's measured in years, you're investing. Mistake number 6 is neglecting storage and security planning. Once you buy physical metals, you must think about where and how you store them. Some people keep everything at home without proper safes. Others rely completely on third-party storage without understanding fees or access terms. In today's environment, security planning matters. A balanced approach often makes more sense than extremes. Mistake number 7, and possibly the most overlooked, is failing to integrate metals into a broader financial strategy. Gold and silver are powerful tools, but they are not the entire plan. If someone empties their emergency fund to buy silver, that's not smart hedging. If someone ignores high-interest debt while stacking coins, they may be losing more in interest than metals can realistically offset. Strong financial strategy means thinking in layers. Cash for emergencies, retirement accounts for growth, and precious metals as insurance. The economic backdrop in 2026 makes metals especially attractive to many Americans. U.S. national debt remains historically high, interest payments continue climbing, and inflation concerns haven't fully disappeared. At the same time, industrial demand for silver and technology and renewable energy remains significant. These long-term forces matter more than daily price swings. If you've made any of these mistakes, you're not alone. Almost every investor has at some point. The key is awareness. Ask yourself, did I buy because of a plan or because of a headline? Do I know my average cost per ounce? Have I compared premiums across multiple dealers? Do I have a clear strategy if I need liquidity quickly? Drop a comment below and tell me which mistake you think is the most common in 2026, or which one you're actively working to avoid. Your experience might help someone else make a smarter move, and if you know someone who just started buying gold or silver this year, share this video with them. It could genuinely prevent a costly error. The truth is simple. Gold and silver can be powerful stabilizers during uncertain times, but only when approached with discipline. The investors who succeed over the long term aren't the loudest voices predicting moonshots. They're the steady buyers who understand cycles, respect risk, and think long term. At Metal Media Insight, the goal isn't hype, it's clarity. Because in a world full of noise, clarity becomes your advantage. As you move through 2026, remember this. The real edge isn't predicting next month's price. It's avoiding the mistakes that quietly compound against you. Stay disciplined, stay informed, stay patient. The next move in the metals market may surprise most people. The question is, will you respond with strategy or with emotion? That decision will shape your outcome far more than any headline ever could.